to the Cash Flow Show with Dave and Nate, the best place to navigate how to achieve capital appreciation with commercial acquisitions. Here's your hosts, Dave Seymour and Nathan Amaral.
Yes. Dave, we are here. You're here.
How are you, bro?
What's up? How are you?
I'm well. We were talking a little bit off camera. I think I'm too well. I'm a little rotund.
You're too well.
My way through this COVID lockdown, dude, and I'm like, oh my Lord! I looked in the mirror and I said, "Who's that fat guy?" And it was me.
I know. So you've gained? Have you gained a few pounds too?
Oh yeah, I probably put on 20 pounds, man.
Oh wow.
20 pounds.
Me too.
So as we were saying though, I've got the elevated desk. Like I'm standing up right now.
Yeah.
Like I got the thing that goes, it like goes up and down.
Right.
So I've been standing up since 7:30, whatever it was. I got in my office this morning.
Do you feel any difference?
I feel great.
I know.
The only time I sat down was at lunchtime.
Yep.
And I had 5 slices of pizza, chicken wings, a box of mozzarella cheese sticks,
ice cream,
and a gallon of ice cream.
Exactly.
But other than that, I've been standing up, and I feel like a rock. I didn't really know.
It makes it worth it. When I first got here and got this new office, I immediately started looking for one. Do you know there wasn't one stand-up desk here on the island? And I just got notification that there's one that just got shipped in like 2 weeks ago, so I have to go take a look at it. It's really unfortunate.
There's a website, I don't know if you've heard of it, it's called Amazon. And what you could do, Nate, it's crazy, dude. Like,
tell me about it.
They got stuff on it, and the shit on it, you can look through it and pick one.
Really?
And a dude will deliver it to you. Like, I don't know how quick they'll get to the Azores, but I think they could actually get to your front door rather than waiting for one to pop up on the car.
Oh my! Is there an app for that? Is there an app for that?
There
is?
It's called GetMyDesk.com. I'm like, are you all right, kid? What's the matter with you?
No, seriously, I can't even get one shipped here on the island. I know it. I even tried Amazon.uk and I still couldn't get one shipped here. They wouldn't ship it.
You can't get one from England. They don't stand up to the work, man. Back home, the only time they stand up is when they're leaning on the bar and the old rubber dub down the pub. Talking about, I thought this was a cash flow show.
Yeah,
what are you doing?
It is. Yeah, well, we'll get there. We're here. We're going to be talking about the differences between single family and versus multifamily, which we both have experience in. And I guess the first question is, I got a few questions that have come in from some emails that have come in recently. But the first question, I think we should kind of open up today's show with maybe a little bit of our background and the experience of transition, right, from single family to multifamily.
That's a great point.
Red carpet for you, sir. You go first.
Give me a drum roll.
As my camera shakes.
No, that's important because we had a marketing meeting this week, and my team all got in the bunker, and I hadn't even thought of it, Nathan. But one of my team members said to me, when you put a message out there, as you know, we're a private equity fund company now, right? So I'm a fund manager. I manage $100 million is what we're shooting for our fund, and we're deploying that capital into commercial real estate, cash flowing assets with value add plays, et cetera, et cetera. And one of my team members, a young guy in the team, I kind of wanted to bark at him a little bit afterwards, but he was on point. He said to me, Dave, he said, what do you know about commercial real estate? You're the flipping guy from A&E.
Right.
And I looked at him and I went, OMG, the guy's right. So here was my answer to him.
Okay.
And it needs to be incorporated into our marketing. And here's my answer to the millions of people who listen to the Cash Flow Show every week, right? It's real simple. What you see on TV is a TV show. Emphasis on the word show, right?
Right. Entertainment.
Entertainment. It was a show. It was a TV show about buying ugly houses with me and my ex-partner, Pete. We fix them up. We sell them. We were very blessed to get the national recognition off of that. But what you don't see is the commercial assets that I have purchased my whole career
Yeah.
with the capital I made off of flipping houses, right?
Right.
So it's never for me personally been one or the other. You and I were both affiliated with a gentleman who was influential in our careers on the commercial side, who had as many as 7,000 units in his portfolio at any one time.
Right.
So every day I learned, I don't know, that, pewter gray is the gray of the color to put on the wall. Make
Right.
sure you use shaker cabinets with the solid white stainless steel handles. Always have a wine cooler. I mean, come on.
Right.
Come on. But no disrespects.
Yeah.
There's good money to make there, but that's a job, right?
Sure.
So all the time I was learning that, I was buying cash flowing assets.
Right.
Small ones, large ones, and bringing in investors to be a part of that. So, I know your career is similar, but I'll throw it back to you. You've never just been like a one-trick pony, as they call it, right?
For a long time. My first deal was, an assignment of contract. It was 2 contracts closed the same week, and that's how I got into the industry of real estate. And it wasn't until I got exposed or hired by our good friend there, and when that whole idea of going from one property to many under one roof was just mind-blowing. It was like, oh, okay, almost the same amount of work and time when it comes down to it. I mean, rehabbing a house can be, you're the ex-flipping guy. I look at this as like also a continuation of the show in a way, if you think about it, right? You just made a good point. Yeah. You said that was for entertainment purposes, but no one saw the commercial acquisitions that you were making. So it's almost like...
Correct.
But
here's why, Nate, right? Mm-hmm. Imagine this. The camera pans to the star of the TV show, Dave Seymour.
Yeah.
And there he is on his computer underwriting...
commercial deal.
Underwriting multifamily assets.
Right.
Looking at the net operating income, coming up with a capitalization rate that makes sense, making sure that there's a preferred rate of return that can get paid to the investors.
Yeah.
It would make you fall asleep.
Right.
So that's why you don't have, commercial house investing.
That's so true.
Episode 1.
Right.
It doesn't have a show value to it. I was talking to a team. They're a young team, couple of guys and their father, and I used the analogy because they're really excited. They're doing really well in their flips. Got a couple of different students nationwide that still connect with me, and I help where I can when time allows. But I said to them, flipping houses, and again, this is no disrespect to anybody who's flipping houses. If your skin's too thin to take an opinion and get out of the business, right? But, that was kind of direct. But flipping houses, I kind of look at it as, that's your first, second, third grade. That's your short pants, right?
Wow.
And then as you get into, your own portfolio of cash flowing assets, maybe you move into the 7th or 8th grade.
Yeah.
And then I got to run out of grades because I can't remember the grade system. I grew up in England, but you get the point I'm saying.
Yeah.
And then you graduate to larger portfolios of commercial assets, whether it's multifamily, which we specialize in. Some people specialize in retail, some mixed use, some office. I mean, if you look at what COVID has done to retail and office space, investors are taking an absolute beating in those classifications, whereas multifamily is consistent, like we showed last week, right?
Yeah.
Multifamily has consistently beat a lot of other investment classes over that T20 look back, right? You look at the trailing 20 years. So, it's a natural progression for the intelligent, for the experienced investors.
Yeah.
And yet some investors, they like to hold. They like to do the same thing over and over. Does that make sense? And that's respectful, right?
No, absolutely. It does make sense. And I'm going to give another side of the coin here, because from my background in going in through single family and stepping into multifamily, if you were to tell me, hey, I want to start my investing career, but you're just going to jump into 100 units. I mean, sometimes one property, one door can seem daunting, never mind 100 doors, right? So that's a progression. I like that word that you used earlier, progression. There's a lot of emotional baggage that people have to work through in their own mind to get over the self-doubt, to overcome the fear. to get familiar with the business. So sometimes I think a lot of people rush in to the single family because they think that's what they can manage. But my experience has been, and you probably have a similar one, is after you've done a 1, 2, 5, however many single families, you realize like, okay, I can easily scale this up now that I got the mental baggage out of the way. I can easily scale this up if I just take that step forward and start making bigger offers. If I expand my mind and get to making bigger offers and look at different types of cash flowing assets. And that was my experience personally. Is at first I was like, okay, how do I do that? But a little bit of knowledge and someone to guide you along the way can help, make that process a lot easier, much more smoother. So
look, man, I've said this in the past, and I kind of like want to check myself today because, a lot of the deliverables in my past were aimed at simplifying what is kind of complicated. Let's just be frank, right? When you get into the commercial arena, the ability to do math is important, okay? Right. And that guy that we've referred to a couple of times who was a mentor to us in the commercial world, he used to say, it's zeros. It's just a zero. You add a zero, subtract a zero. Yeah. And I was coming from that blue collar background. I'm like, yeah, that's easy for you to say, buddy. I've been trying to trade time for money. Yeah. But here's the thing. And look, Nate, I've said this before and I'll say it again. There is no right or wrong. This isn't to bash single family buy and hold investing. It's not. Right. I met a gentleman in the Midwest, and I'll never forget this guy. He had 3,000, I want to say, 3,000 single family homes scattered throughout the Midwest. And I'll say, I can't remember exactly, but Oklahoma in that kind of geography. And he was in his late 60s, early 70s. And I remember striking up a conversation with him. He's probably still in my phone today. If I went digging deep enough, I could find him. Mm-hmm. But I remember saying to him, I said, how has that been for you? And it was funny. He said, I own them all free and clear. And he had built his business model around him. Okay. So bear with me. Right. He had built the whole business model around himself. Mm. In other words, he was the chief cook, bottle washer, landscaper, contractor, investor, right? And he owned them all for like 30 plus years. He was an older gentleman. And that had been his complete and utter lifelong's work. Mm-hmm. Now, some people would say, you're crazy. Some people would say, that's fantastic. So it's not a right or wrong. But I had conversations with him at that time, and I said to him, what do you think your quality of life would have been like if those 3,000 units, like I'm looking at a property in the next couple of weeks, 1,600 doors on one unit, right? Okay. So basically, you could buy 2 properties like that, and instead of traveling to 3,000 single-family homes, you could travel to 2 properties. As a fund manager, we could quite easily take that down. And I just said to him, what do you think your quality of life would have been like? And he looked at me, and I never forget this. He looked at me and he said, I might have had maybe 2 less wives if that. And he gave me that wry smile. Yeah. So look, it's a DNA setup, bro. Mm-hmm. Some people are content with, that single family. And if it's a smaller portfolio, you and I both know this, and I know you've experienced, and I have. If I've got one house and I lose one tenant, how much of the cash flow do I lose?
All of it.
100% gone. 100%. Right? Gone.
That's right.
But I still got to pay the bills. I got to still pay the taxes and the insurance. Whereas as soon as we, graduate the game to the commercial world, we now have what you and I know to be the economies of scale. Yeah. So why don't I pop it back over to you? You tell me your single sentence, if you will, for economies of scale. What does that mean to you?
Well, for me, at the core of it, to me, it means more time and more freedom, right? At the core of it. So when it comes to saying, okay, am I going to, I like how you put that earlier, am I going to go look at 1,200 doors, or am I going to just go look at one or
One,
two
one
buildings,
unit.
right? However many buildings it's going to take. Yeah. So that's the biggest defining part. And in my mind, I always think about roofs, and that's how it's like, maybe because I was trained that way, right? It's always the amount of roofs.
Yeah.
Like, if you're going to build a portfolio of 100 doors, are you going to do 100 roofs, or are you going to do like 2 roofs or 1 roof? And that's how I look at it. And I think it's so much easier, especially when I think of many properties. I think of more responsibility, more management, and that's spread out all over the place. And actually, I built a portfolio like that in North Carolina. Got over 30 single family houses. And guess what? They're a little spread all everywhere. But then
Sure.
when you buy a complex of properties, right, and you buy, whether it's, 100 doors, however many doors, guess what? That's all at just one location, right? You could actually do a pin drop and drive to that one destination, and there you go, you're at your property. And that's a beautiful thing. So I look at, when it comes to economies of scale and the difference between the two of single family to multifamily, it's the time saving factor. I think my favorite part though, Dave, is the partnerships. And a lot of people like say, I think struggle with this. When people are jumping into real estate, they think like, how can I do this on my own? They think about them and their own. And there's always this line, maybe you've heard this before. I'll do that once I get the experience. Let me learn it first, and then I'll get the experience, right? And I just combat that thought process, because the reality is, if you take any CEO of a company that's on the whatever, has an IPO, they're not learning every detail of every process, right? There are people in place to make that happen. Now, they may learn it as they go along or learn the problems that are happening, but they're not learning every intricacy that's going on. And so that's called the difference between working in the business and working on the business. And I think a lot of people, what they do in single family, they work in the business. And then when you step out into multifamily, you tend to work on the business. So you may not be that person who's fixing the light bulbs or getting the phone calls for the toilets and stuff like that. That's managing the manager. And I look at that as working on the business. So just that transition of going from single to multi, I look at it as in the business and then on the business. That's been my experience.
I love it. As you're talking, and I concur, young man, with all the points that you make. But as you're talking, I'm thinking about my own journey in multifamily, right? So as I was in multifamily, my ex-partner and I bought different value adds to the deal, right? To the business, because multifamily is a business.
Yeah.
And it needs to be looked as one. It needs to be built
business,
as one.
Yeah.
The business has income and expenses.
Right.
It has clients who
Right.
need to be serviced. It has marketing that needs to be tight
Right.
and on point and delivered.
Right.
We talk a lot about repositioning of an asset, which is where the value comes for us as investors. Badly managed, badly tenanted, whatever the challenges are, the deferred maintenance, et cetera, et cetera.
Right.
So there's this this growth, if you will, this transmission that occurs, to use the analogies we've been playing with, on the single family up to the multifamily. And then I like what you said. You talked about partnerships, right?
Yeah.
So in the syndicated world, it is a partnership. And for
Right.
folks who are listening who don't know, a syndicated deal is one deal sponsor, experts, pooling capital, investors, maybe 5, maybe 10, maybe 20. What they do is they then put down the money down on the deal. So we'll say a $5 million acquisition. They raise $1 million. They put that down. They got 20% down on this acquisition because they got $1 million.
Yep.
And then everybody is in on that one deal.
Right.
Now,
Right.
if that one deal was maybe a retail deal like we just talked about, or if that one deal was in hospitality, my Lord, imagine if you're in hospitality right now.
Not a fun
right?
day.
And that one deal starts to do this.
Right. Yeah. Yeah.
It is what it is. It's real estate. It's risky, right? It has its inherent challenges. So syndication deals can also be fantastic, and they do this, right? They've got a beautiful trajectory up. They can be liquidated out of that asset, out of that particular property, whatever it is, in a lot of syndicators will hang in there for maybe 5 to 7 years, reposition, exit out, and they show fantastic rates of return.
Yeah.
But then the next level up from there, well, now you get the economies of scale on top of the economy of scale.
Right.
So if right.
So let's explain that. Let's explain that in a little more detail.
So let's say, for imagine's sake, there's a private equity fund, similar to ours. And that private equity fund decided to heavily invest. Maybe 40% of his allocation was in retail, and 60% of its allocation was in multifamily.
Okay.
Maybe we'll change that out to 20-80. Maybe 20% of the allocation was in retail. What a fund now allows us to do is to take diversity and economies of scale within the fund, because the capital works across all the different assets that we buy. So if one asset, in the example I gave you, was a retail asset that took a nosedive during COVID, the fund managers are able to adjust and say, well, okay, we're doing pretty good over here in the multifamily side.
Yeah, exactly.
We're still at 98% occupancy. We're at 95% rent collection. That can offset some of the challenges in some of the other asset classes.
Exactly.
So that's why a fund, right, gives you that next level of protection as an investor. Does that all make sense, Nathan?
Oh, yeah, it definitely makes sense. And as you're saying that, I'm actually I was going to pull up one of the funds that, there's two funds that I'm in. And one of them is, I want to say, I don't know if it's a Hampton Inn fund or something like that. It's definitely a hospitality fund. And the other fund is apartments out in California, and very low cap rate. And I'm actually trying to look for it right now, and I'll find it in a second. But the reality is as a limited partner, as a silent partner on that, as I like to call a silent partner, passive investor. The reality is that hospitality fund is just not going anywhere right now, right? It's like everything's all the brakes are on. So, but then you have other places of other acquisitions, that other properties that are going on where it is turning and burning, and it's growing. And I think, and I'd love to get your take on this. By the way, I'd love to know, what is your personal future projection on the, let's just say, the way everything's going, we're hearing a lot about forbearance coming up, but we're now increasing foreclosures. And I just did a video about this on Monday, that now people are skipping out on their leases, and it's already starting in California, Los Angeles, the Semi Valley, as well as San Francisco. People are just skipping out on their leases. So what's your take on that? But for the future, though, it's a little bit of a transition here, but what's your take on that?
No, I'm with you. Look, and I don't have a crystal ball, neither do you, neither does, BlackRock. Everybody's got an opinion, right?
Yeah.
I like to bring some common sense to all of this data that's out there. And we talked about this yesterday. The little blurbs that I shot out on my Facebook page prior to us going live, I kind of tied it in a little bit to the 4th of July. Okay. So tomorrow is the independence of this great nation, Nate. You know what I mean?
Yeah.
And who did they get their independence from? The British.
Yeah.
Right. We let them win that one, guys, right? But,
yeah, you let them win in war, but in finances,
right. So the blurb I put out there is what really is independence? Because we talk about independence, birth of a nation, right? And we stood up strong and we said, no representation without taxation. Yeah. And yet, over the life of this great nation, it's taken some incredible turns, left and right, up and down, economically, socially, et cetera, et cetera. And I'm not making a political statement, but what I am telling you is this, is that financial dependence on somebody else is a broken model, period.
Right.
Say it again. Financial dependence upon somebody else is a broken model. And what I mean by that is your retirement going to work for you? Is Social Security going to be there? Does the 401k look like a 201k, and does it now look like a 101k? Right?
Well,
But it's true. It's true, Nathan.
Yeah,
I mean,
I know.
where is your independence? So what happens is you get this small pocket of educated, like they talk about, the 1%ers, bad people. Guess what? I was never aspiring to be part of the 1%ers, but real estate gave me the skill sets and the ability to help not only my family, but other people's family. So watch.
Yeah.
You asked me where it's going. Here's where it's going. Because I bring core fundamentals, I understand that people are always going to need a place to live. I also understand that COVID has scared the absolute crap out of this country to the point that big cities are going to see some migration. They're going to see some movement.
Yeah.
You're going to see population growth in the secondary and the tertiary markets outside of our metropolitan markets, right? That's going to give us an opportunity as educated investors to not have to compete with the big boys in multifamily. Let all of the big institutions take the 250 units and the larger properties. Let them have all of those.
Yeah.
Us, educated investors, I'm going to take all of the other units that come down. I'm going to give these people fantastic, clean, safe, beautiful housing that they will have the financial ability to pay for. So that dependence on somebody else for the investors isn't there anymore. Now it's just dependent upon the execution of the business plan to be able to, retire in safety going forward. I think office space is going to be challenged. I think you're going to see some fantastic leases coming up on price per square foot in office space, both luxury as well as non-luxury. And I think retail. Look, we've proven that people do not have to go to restaurants. We've proven that people do not have to go to the mall. But we've proven that people do not have to go to the office. Now, whether they choose to when all dust settles, I don't know. So that's kind of like a little bit of my rant.
Yeah. I'd like to touch on that also about the offices in just a second. I want to bring up that Tom makes a point here. When you were talking earlier about funds, he says the fund helps mitigate risk. So, as diversified assets. Then he also says Tom is pivoting to buying buildable residential tracts. He's getting approvals and selling the deal. So I'm just, what is a buildable residential tract? Are we talking about a land or like what?
Yeah, so those are land deals. There's a lot of that going on in Florida because Florida's so it's so overpopulated and the amount of construction down there just hasn't met demand.
Yeah.
So those buildable tracts, hey, I get it, Tom. Yeah. No, I'm with you, man.
Yeah.
That's a business plan that may very well execute nicely.
Yeah.
Develop the land, make it shovel ready, sell that to a.
And that might be, oh, Dave, you there? Oh, all right. I think we lost a little bit of Dave there for a second. Hold on. Dave? Oh, got a little, all right. So Dave is a little frozen. Like the movie. Oh. So Tom is while we get Dave back on the line, we're having a little technical glitch on his side, but we'll get him back. Tom, if you just want to elaborate a little bit more on what you're referring to about the residential tracts. I think we're on the same page here of the residential tracts being tracts of land. Is that correct? And we'll see if we can get Dave back up here in just a second. Yeah, I know, Tom. He's frozen. Yeah, we're working on that. He's frozen like the movie. Dave is having an internet connection issue right now. But we'll get him back on the line. So, Tom, I'd love to hear back from you about that. Is that what the case is on your end? You're building tracks. Now, one of the things that I have been seeing, right, exactly, yeah. One of the things I've definitely been seeing, especially in the single family space, is that because there is lower interests right now, right, lower interest rates, there is, yeah, exactly, land development. Thanks, Tom, I appreciate that for sharing that. Because of the lower interest rates, and Tom, you could probably elaborate on this also, is the lower interest rates is causing like this buying frenzy. Actually, I have a good friend of mine who his dream was to buy his own house and build his own house, and he's actually getting it done now. And that was a dream like 10 years ago, and actually it's now coming true because of this unique situation in the marketplace, right? So that's probably what we're seeing a lot, especially in on the outskirts of big metropolitan areas. So whether it's, Orlando's a booming area, Texas, different parts of Texas, many booming markets down there, which is great. I mean, it just goes to show that in real estate, even though we just came out of a very volatile last week, we talked about the stocks, dipping down, really hard, and how volatile the stocks are. It just shows that real estate is still pushing through, and we're seeing that. Very true. Bid wars all over New Jersey. Yeah, that's very true, by the way. Bidding wars all over New Jersey. Yeah. Actually, I have some good friends out there who are they're not in the land development side of things. They're actually in the rehabbing side of the business. But that goes back to what we were talking about earlier, is that you can be in that system of rehabbing houses where it's one-offs rather than a bunch all at the same time, and that's basically what we're chatting about when it comes to the differences between single-family houses and multifamily houses. And I think from my experience in sharing this earlier, it's been going from a bunch of, whether it was flipping contracts or doing a little bit of rehabbing. I haven't done a whole bunch of rehabbing because that's not my skill set. It was a no-brainer for me when I heard the presentation, of going from going from many roofs to one or two roofs on a project. That for me was a game changer. Yeah, so thanks, Tom, for elaborating on that. Thank you so much. Yeah, there's a bunch going on, and I think that's what we're seeing in regards to the land development side of it. Let's see. I think Dave's coming on right now, actually. Dave, you there?
Yeah.
Sorry.
So we lost the internet. So thank the Lord you taught me that I could have a personal hotspot.
Wait, your connection is really slow. You there, buddy? Okay. What do you have?
Yeah.
What do you have on your phone?
I'm working on hotspot. I lost my regular internet.
Oh, you lost your internet. Why? You're not paying your bills?
Oh, this new office building comes with internet service, and it just crapped the bed. Let me. Do you want me to try and connect to it again?
I mean, I can see you clearly right now. It doesn't look like there's anything bad going on.
Okay. Then we'll stay on the phone if you want to stay on the phone, and I'll talk very, very slowly.
Okay. All right. So we while you were gone, Tom and I were just having the discussion about land development and where he's buying inner city suburbs. And then Vamsi is asking, how many doors do I have? Well, let me see. I have one door here in my office. I have one door at home.
One over there.
Total, it depends. Not single family if you're talking doors, because I have a few different properties. Right now, I'm probably up to about 100 and, I don't know, about 130, 160. Not include, I mean, that's it. That is including single family doors. So, because I do have single family, a lot of owner finance properties. But in groups, like I have a 66 unit. I do have a hotel deal I'm a partner on in Dallas, small hotel. And then also the other multi-unit properties that I have, and then the 26 units I have here, and then the short-term rentals I have. So I would, if I was to throw it all together, it's probably around 160 in that ballpark. So to answer,
I wanted to just kind of like throw my 2 cents in on Tom's commentary about tract housing. If that's a strategy to buy and hold, then it could very well be a nice strategy, right? Maybe it's a 20-tract development or something like that. You got 20 doors are all right there. I look at that as a nice 20-unit apartment complex. the challenge I see with housing is that potentially if it's to buy it, build it, and then sell it, I'm not overly confident that all the buyers will be there when we need them, 8
That's a good
months,
point.
12 months, 14
Yeah.
months from now. So that's just, and again, no right or wrong because I don't have a crystal ball.
Right. Yeah, of course. I think that's more of like, back to market demand, right? And we're seeing an increase in market demand right now. We're seeing, we haven't seen the banks pull credit on people. We're seeing an extension of credit. And so people are having more opportunity to, by the way, just, I want to ask you a question about that. We're seeing more people have, more extension of credit. But how does that impact you on the commercial side? What are you seeing in that regard? Maybe the differences of single family and multi-unit.
There is a tsunami of investors going to their lenders to reposition their capital. The interest rates for commercial are just so attractive right now that the upside cash flow is huge. However, it's still dependent upon a professionally managed asset. Like the books have got to be right. The debt service coverage ratios still need to be in position.
Yeah.
So, the professionals, they're going to be okay, right? The professional fund managers, the professional asset managers are going to be okay. But the smaller, what we call them mom and pops, are going to have some challenges getting that kind of financing in place. So big picture is it's absolutely the right time when it comes to commercial financing.
Yeah. Yeah, I've seen that also. I've also seen a lot of like stimulus money come to the marketplace also, right? You probably seen or heard some of that. I mean, that's picking up quite a bit.
Absolutely. Look, man, it's just going to be interesting to see, how independent we truly are when the stimulus money needs to be paid back and or forgiven, when the forbearances come due, when the unemployment checks aren't coming in anymore. I mean, we had great numbers today. We had great jobs and unemployment numbers. We're all moving in the right direction. But if it's built on a house of cards, if it's propped up by the government, it's not based in fundamental, GDP and growth and spending and all the things that these numbers are truly based on, then I have a concern. And with that concern comes, like I've said, fantastic opportunities for us as commercial investors.
That's so true. Hey, Dave, one last question before we end today's show. It's coming from Vamsi. She's asking, is Dave buying in this market with rent deferral talks of forgiveness?
Yeah, great question. And the answer to that is yes. Because when I buy, so my buying is going to be mid Q3 to the end of Q4. So we're in the capital raise phase now, knowing that a lot of these challenges on rent deferral and forgiveness, that's the opportunity. And it is what it is. I didn't make the rules, but I promise you I'm going to execute on the plan based off of what comes next, which is the inability for some tenants to pay. Rent collections go down, NOI goes down, value goes down. When value goes down, I come in and buy.
Right.
Yes is the answer. Yeah, I'm buying aggressively. I'm very, very bullish on this market.
Yeah, absolutely. And actually, you know what? We should kind of stop it there because that's kind of cutting into our topic next week about what you're buying. We're going to go a little bit deeper into that. And so let's kind of put the brakes on there. We answered a bunch of questions and we'll transition into that for next week. What do you got planned for the weekend, Dave?
Nothing, dude. It's the 4th of July.
No, you know what I mean.
Like, and cry.
Yeah, I cry.
I swear to God, dude. When I first came to the States, real quick.
Yeah.
I first came to the States. I lived in West Virginia. Oh, God. And I remember this big old boy came up to me at a cookout on the 4th of July, and he says to me, he goes, are you having a good time on the 4th of July? And I looked at this guy and I said, why you got to be like that, man? I said, my great-great-great-great-great-great-great-great-great-great-great-grandfather died at Bunker Hill. And we've never, ever forgotten that in our family. It's been very painful. And now you're making me celebrate. And he looked at me. It was like he just couldn't resonate. So what am I going to do? I'm going to hang out with my 3 boys,
That's awesome.
my beautiful wife.
That's awesome.
I'm going to eat a couple of steaks. I'm going to watch a firework or 2 as it flies through the sky.
Nice.
And I'm going to get up afterwards and I'm going to rock and roll and go to work, go to war, and do great things. That's my plan. What
That's
about
awesome.
you? What are you doing?
Awesome.
You celebrate out there on the islands?
What are we going to celebrate? What are we celebrating? There's no independence here. No,
American, first of all.
Yeah, but I'm not going to be here with my American flag. No. But I do have a cookout tomorrow. My good friend here actually invited me and my family. We're going to have a group cookout, a German, 2 Portuguese guys, going to all get together and have some good Portuguese steaks. That's what we're going to do. So it'll be a good time.
Awesome.
Of course.
I'll raise a club soda.
Oh,
you gonna dance?
Dance? Well, no, we're gonna do some dancing. You gotta have some dancing going on. And yes, club soda, right? No strawberry. What is it? It's Coke
club
and
soda cran.
Yeah, cran. Yeah.
Club soda cran. All right. I'll see you next week, brother.
All right, man.
Miss you,
Sounds good.
God bless.